Well, welcome everybody. I am so glad that you're joining me. Today we are talking with Christian Mack. Hi, Christian,
Hello.
who is one of the managing partners of Lotus Domain. And Lotus Domain is one of the members, a premium member of GLO, and is about to launch an offer on our investment platform that we would really like you to take a look at. So I'm going to take the next 20 minutes of your time to interview Christian, learn a little bit about him, about Lotus, and about their new fund number 3, the Technology Acquisition Fund. Christian, tell us a little bit about you. How long have you been in the fund management space, and how did you end up being such a tech guru?
I really appreciate the invite, Joseph. So I started out spent most of my life in Chicago. I actually went to University of Chicago with a math major and put myself through school by taking on the odd IT job. As I like to joke around, this was the late 90s, and because everyone thought the world was going to come to an end thanks to Y2K, and because I could also spell IT, I became an IT consultant for a couple of years.
Oh,
and then I
fantastic.
realized,
Did you get one of those great contracts where they paid you for the whole year ahead of time?
I did not. I was pretty much an underling at that point, so I was not the benefactor of that. But I basically at that point I decided that billable time was great, but there's only so much billable time in the day. So I decided to start a software company, and that software company is still around today. It's called Resolve Systems, and we started it in 1999. We grew it successfully throughout 2012, at which point we had a successful exit event to a private equity company in New York. At that time, I took a couple of years off. I started a family office, and then realized that there was really an opportunity within the enterprise software space that was not exactly being serviced from a traditional private equity sense. Under these companies, these underperforming enterprise software assets, that really, if there was the right best practices implemented, best practices that we had learned actually in my first company, and implemented those, we could get those assets to profitability and also get those assets growing again, and thereby basically growing these things into the feeding frenzy of traditional private equity capital. And so in 2014, I launched Lotus Domain with David Roman, who's my partner, and we've had three funds so far. Fund 1 and Fund 2 have been fully realized, and Fund 3 is off to the races. We started it late last year.
So, and that's the fund that we're talking about today, that we're going to that you're going to be doing some fundraising on the platform. It's an enterprise software buyout fund, and so could you talk a little bit about that space? What do you mean by the underperforming middle market enterprise software space?
Yeah, so typically what we're looking for are companies that are between 5 and 20 million in revenue. These companies traditionally have not been profitable. They've been run more like a lifestyle business. Right. And it's usually because the founder themselves is more of a technologist, and they're not really a CEO, they're not really a CFO, but the technology is really great. The technology is something that, when we say enterprise software, we really mean business to business software. So the electricity, plumbing of a very large company is what we're referring to. And so our methodology basically identifies these opportunities, goes in, focuses on getting these companies to profitability because we believe in sustained growth, and then also focuses on the front office, getting sales, marketing, business development going, again, underneath new leadership that knows how to actually grow companies and has had successful exits before. Now, the founder themselves typically is then focused on what they're good at, which is the technology themselves. And so if you get into a situation where that $5 or $20 million company ends up being 20 plus million in revenue with 3 to 5 million of EBITDA, there is a tremendous number of private equity companies out there that will buy that asset.
So I was reading the fantastic pitch deck material that you guys have put together and is available on the GLO investment platform for the qualified investors to look at. And it's not the entire enterprise software space you're looking at. You're actually in Fund 3 doing some additional targeting. Is that correct?
Absolutely. So one of the things that was really important for us is in my first company, it was very much focused in automation. And one of the things that we realized was that some of the best years of that company were the dot-com implosion and the Great Recession. And I asked myself, why is that the case? And at the end of the day, what it comes down to is these Fortune 500 companies have to figure out how to deliver the same type of service with less people when recessions hit. And especially when COVID hit, now you're dealing with less people and a remote workforce.
Right.
And so there are actually specific segments within the enterprise software market, namely automation, collaboration, security, the AI space, machine learning, platform as a service, and IT operations that are actually very recession resilient. And we've actually back tested this with one of the leading IT analysts out there called Gartner. And these particular segments do really well during good times, but do extremely well during downtimes, because again, there's a flood of money that comes into these spaces, these segments, when that occurs.
So obviously we've been in a recession for the last year due to COVID. So that would seem to say that these specific sectors of the enterprise software market that you're targeting would be really good acquisitions. What about with the market turning around here a little bit and projecting growth over the next year?
No, so a couple of things. So within these segments, even though these segments are actually growing, there is actually these companies that we're buying, we're taking controlling buyout positions in. These companies are struggling, and normally it's because they're running out of money, and they're running out of money because the owner is just frankly out of money, or maybe the ownership is running out of money. That's not necessarily the founder, or perhaps it's the bank that's basically going through a workout process. So there's actually opportunities within these segments that are actually growing during these downturns. And specifically with COVID, to address your question, what's interesting about COVID is that it has fast forwarded the IT spend, much faster than previous recessions. And even though we're, recovered and going, things look great, on the horizon, the actual IT spend has really kind of doubled down in this space, because so many of these big companies are trying to basically figure out how to uplift their IT infrastructure footprint to effectively take into account, a tremendous amount of remote workers, as well as a very highly competitive landscape in this new market.
Yeah, it's just really changed the entire dynamic for them, hasn't it?
Absolutely.
So Lotus Domain identifies these companies, and then your methodology of experienced operators does kind of a turnaround or a kind of a growth strategy. Let's jump back here. How are you finding these companies? Are there a lot of them? Do you need a good percentage of the market? How many are you really looking at over the course of the 10-year life cycle of the fund?
So we look at a lot, but I would say that there's a lot of companies in this space. For instance, if you go to IBM's website, there are literally thousands of partners, and those partners usually have enterprise software as a part of it that adds value to that ecosystem. And that's just one big company, a very large enterprise software company, but there are a lot of those companies: SAP, ServiceNow, Oracle, you name it. And so within those ecosystems—
What you're saying is within IBM's ecosystem of companies that are partners to them, most of them fit this target of lower middle market technologies companies.
Absolutely. Well, so what we do is we go there.
I'm sorry, give me an example.
Well, so one of the companies that we bought was a $4.5 million revenue company. We got in there, it was losing about $1 million worth of EBITDA. They had no sales team, which is not actually uncommon in this space. No, obviously they were losing money, and again, that's not uncommon in these situations. And so we came in, we put in a new CEO. We basically got involved. We got the front office turned around, i.e., sales, marketing, and business development, with the objective of getting to 20% year-over-year growth within that particular company. But we also had a back office turnaround team that got deployed, and they focus on finance, IT, and HR with the goal of getting to 20% EBITDA within a year or less. And so the combination of those two things effectively gets into a very, great sustainable growth scenario. And that company, within 3 years, basically turned into a $14 million revenue company with a 3 to 4 million of EBITDA, which is actually highly sought after, and with a great customer base.
Right, and that's just perfect for the private equity firms. That's exactly what they want. So you basically are custom wrapping it for those exits.
Yeah, and our team really gets embedded within these companies in the beginning, but once those missions are accomplished, they basically peel out and leave behind them the right people, process, and products to ensure that sustainable growth continues with the new leadership, which is really important.
So how many different companies can you handle at one time?
Yeah,
To
so that's
do
a
that? I
great
mean,
question.
you've got a limited staff, my assumption is, and they can only run so many companies.
So we actually, so in Fund One and Fund Two, we had just David Roman and myself and a handful number of other folks. We've actually scaled the team out significantly. So now we have 6 people inside the general partnership, and those people are the folks that really do a lot of the deal flow analysis, the underwriting, the acquisition, and ultimately get involved in the integration within the team. But above and beyond that, we have a team of about 13 people that are actually doing the hands-on heavy lifting and so forth to get the company to profitability and to revenue growth. So to answer your question, that team itself could easily do 2 acquisitions per year, which is what our Fund 3 is focused in on. But it actually could scale quite a bit. The team itself is a great combination of folks that have been both successful operators with multiple successes, as well as folks that have been operators that are really focused in and enjoy the turnaround projects that we get involved in.
So your the Fund 3 will be targeting 2 acquisitions a year, and that is fundamentally for the first 5 years or the first 10 years.
Yeah, great question. So it's a 10-year fund,
Right.
but our whole goal is to make 2 acquisitions per year for a total of 10 acquisitions. So we'll be acquiring companies for the first 5 years. But starting in years 2, the whole idea is that we basically get to a situation where we can create an annual yield. An annual yield of 8% is our target starting in years 2. And that comes from the profitability of the underlying companies that we've acquired. From there on out, after things have been turned around, we're going to start selling these companies ideally between years 4 and 7. And so folks can basically see the results of their investment, during that timeline. And then we'll have a few more years as well, just in case we want to hold on to something. Because at the end of the day, if you have a highly growing company that's very profitable, like why wouldn't you take advantage of that?
So. you can hit that targeted return a lot easier, can't you?
Absolutely.
So and these numbers, you're not pulling them out of projections. I mean, this is your experience in both Fund 1 and Fund 2, correct?
Absolutely. Yeah. Fund 1 and Fund 2 had great returns, 30 to 40% IRRs, which we're very proud of. Those are all realized. And we think that we can do that and potentially more, depending on the situation, because COVID has actually presented us with a tremendous amount of deal flow. There's never been deal flow before that I've seen that it has both higher level quality and higher number of quantity distressed enterprise software assets that we are looking at.
Right. So why Fund 3? Why not just expand Fund 1 and 2? What's kind of the uniqueness of the this fund portfolio?
Yeah, so Fund 1 and Fund 2 were 5-year funds. They're relatively small in comparison, but I really wanted to make sure that at the end of the day, that the proof of concept really worked, right? Before getting into an institutional level fund, that we were able to work out, all the kinks, and there were a lot of lessons learned, but the ultimate result was obviously very good for investors in Fund 1 and Fund 2. Now we're wanting to take the next step, which is get into that institutional level fund where we can apply the systems that we've built in Fund 1 and Fund 2 and really scale this to a new level.
Great. So how much did you raise and pull in Fund 1 and 2, and how much are you trying to do in Fund 3?
So Fund 1 was about $10 million. Fund 2 was about $32 million. But again, it was David and Roman and myself with a handful number of others doing that. The results, like I said, were about 30 to 40% IRRs. And during that time, I think we again learned a lot. But now as we go into Fund 3, we have 6 people within our team, and our team is comprised of folks that all have enterprise software experience, but also more specifically are not only operators but also have private equity background and success. And so the combined team has done over 35 transactions in this particular space and has placed over $300 million of capital. And so for us, we have a much much bigger team that is we're leveraging those guys' experience in addition to ours and kind of taking it to a next level. Our goal in Fund 3 is to raise $150 million. It is a commitment fund, so we target pulling down around 20% per year. And ultimately speaking, we hope to achieve not only the 8% hurdle rate and accrete that via dividends, but also, target returns that have historically been in that 30% to 40%, arena.
And the management fees and incentive is a traditional 2 and 20.
It is, and I get asked about that a lot. I think at the end of the day, it is a 2 and 20 fund, but unlike most traditional private equity companies, we're really getting our hands dirty, right? We're getting operationally involved. It takes a lot to turn around a company, even though we may make it look easy. And so, that 2 and 20 is there to effectively do more than what you traditionally see in a traditional private equity company.
So I was going to ask that. Are the people that you embed also sitting on payroll? So are you also compensated operators above and beyond that 2 and 20, or is that an all encompass?
And that's all encompassing. So like folks are basically getting involved and tapping into the team. And the other thing I would also add is that
Christian, I think that's a huge deal. I just want us to stall and talk about that again, because that's I work with a lot. I work on the other side and interact with these a lot, and there's a lot of 2 and 20 funds that then hide a whole bunch of additional revenue to themselves from the portfolio companies as additional consulting, right? Yeah. And often put it in as a requirement, right? You have to hire so and so as your CFO, and you look at the total load carry, of the investor, the fund, it's pretty significant.
Yeah,
so
I would say, the new leadership that we do bring on though is paid by the company. I don't want to give you that impression, but the work and efforts to find deals to help be that thought leadership, around turning around things and so forth. Absolutely. I mean, our goal is really to kind of take this to the next level, and which we're doing in Fund 3, but one of the things that we really want to do is partner up with folks that are, going to be strategic partners for us. So, the folks that will contribute in Funds 4 and 5. We've had a tremendous number. All of the investors in Fund 1 came into Fund 2. A large percentage. Obviously, we're fundraising now, but a large percentage at this point. 80% have come from Fund 2 into Fund 3 already. So we think we're actually going to be oversubscribed. But before I move on to that, I just want to kind of point out also, over 50% of the deals that we've done in Fund 1 and Fund 2 actually had co-invest. And so one of the things that we do is we try to be very methodical around, investing, that basically writing $10 to $15 million equity checks. Now, sometimes we get into situations where there's more money that's needed beyond that. And so what we've done in the past, again, around 50% of the time, is actually turn to our LP community based on their commitment size and allow them to co-invest. And I bring that up because I think that's also a differentiator for us, because we don't actually charge management fees on that. It's something that helps the folks to kind of water down the 2 and 20 scenario, and it's actually worked out relatively well, I think, for them.
And you're bringing so much additional strategic support. Then I think that's pretty phenomenal.
Yeah.
So are there some companies you're already eyeing that you're pretty excited about?
Yeah, No, we're actually, we've already made a small investment in a company late last year. It was not a buyout investment, but it was an opportunity to buy into a company from a minority perspective that really is involved in this ride share, delivery share, type of arena, which we're pretty excited about. But more importantly, there is a very large investment that we're about to make in the next coming weeks. That is, right up, our alley. It is a great opportunity whereby we're going to be buying something that is in the automation space, and something that has a tremendous number of Fortune 500 companies, and it just really needs, our thought leadership, the application of our methodology, and then also the growth capital needed to take it to the next level. So we're really excited about that, and quite frankly, excited to see how happy investors are once we're able to monetize that.
That's fantastic. So what's the minimum investment?
So it's $1 million commitment, but we target pulling down about 20% per year. So it's about $200,000 per year.
And I saw in the paperwork that additional units are 25,000. So folks can go up from that $1 million.
Yep, that's right. From that commitment. Yep, absolutely.
That sounds great. And what percentage of it is subscribed so far at the time of this? It's April 22nd.
So we've got just a little under a third right now already subscribed in there. So we're pretty excited about that. One of the other things I just also want to mention is the general partner itself has already committed $19 million to this fund. So in many ways, we're putting a lot of money where our mouth is in this. We certainly need the fees in order to pay the payroll for folks, but we're very, very interested in seeing that $19 million accrete that 30 to 40% return. So
that's fantastic. I love it when somebody's got their own skin in the game, not just their IP, which you certainly do, but some cash as well. That's fantastic. Great. So tell me, if I'm an interested investor, I'm looking at a lot of funds. I got to tell you, there's a lot of funds claiming fantastic returns today. There's SPACs knocking at my door, telling me how fantastic it's going to be for me to be public right away. A lot of distressed assets being picked up in the real estate space. Why should I choose this one over all those others?
Yeah, so I think that we're interesting in that our main competition really isn't other private equity companies. It is actually the owners of these companies who, unfortunately, continue to write checks because they just don't have the benefit of the methodology that we come in with. So above and beyond that, though, again, once you take a company that is 5 to 20 million in revenue, that's losing money, and you turn around into a company that has 3 to 5 million of EBITDA, that really unlocks a lot of doors in the traditional private equity space. So I think that the reason why people should be interested in this fund is because we have the ability to, I believe, historically shown that the consistent returns of value dislocation, of taking advantage of that value arbitrage is really important. And the traditional private equity companies don't necessarily have the operator backgrounds that we do. And so, they can't necessarily see the diamond in the rough that we can and have the capacity to turn things around and actually, consistently benefit from that value creation. So I think that's why people would be interested in us.
Yeah. I've had that experience personally with companies, just the getting that founder out of that primary role, letting them focus on what their core value that they brought to the company was, and often bringing on a real enterprise sales team is really all that it took to triple the value of the company. And as you said, move it into that key sweet spot for the private equity, which gives your fund the return that it needs.
Yeah, and I'm empathetic to the founders. I mean, heck, I used to be one, right? But I've certainly benefited from stepping in all the wrong potholes at all the wrong times and figuring out a way to recover from that. And again, at the end of the day, I think it's very challenging as a founder who's never had that experience before consistently and doesn't have the growth capital to be able to approach it pragmatically. I'm empathetic to them. And look, at the end of the day, the value present, or the value that we bring to these founders is, yes, you can continue to write checks into this company and try to grow it, but isn't it better to partner up with somebody like a Lotus domain, right? That at the end of the day, granted, you're going to have a smaller piece, but a smaller piece of a bigger pie. And we have the track record to prove that we can actually get, to that success scenario so that you can have a successful, exit. And the money that we're actually putting into this company, the $10 to $15 million equity checks, it's really about funding that turnaround. It's really about getting enough growth capital in there to be able to do it. And, sometimes the founders are taking some chips off the table, but this is by no means, retirement day for them. This is, okay, it's double down day, Yeah, exactly.
Well, thank you, Christian, so much. I really appreciate it. This is a fantastic opportunity for GLO's members, our investor members. I'm sure there'll also be some of the operating members who will say, gosh, I need to get my company to a place where we could be appealing to Lotus. But I'm really very excited to make this offer available to our investor members. You can click through on this right under where this video is, under the notes, it'll say view the investment details here. You'll go into the investment portal. You'll be able to see all their documentation, all the PPMs, the subscription agreements, the disclosure agreements. You'll be able to chat with Jeff and Darla and the other members of the team And then there's the fully automated process so that you can get in minimum of $1 million, 20% drawdown a year. Fantastic opportunity. Hope that you'll take a look at it.
Thank you, Joseph.